Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Dr. Yusof. My name is Muhammad Kamal bin Muhammad Khairami. My number matric is H24A 2882. We are from Group 11 from class Financial Management L4. We'll present about our group assignment. Financial management is the process of planning, directing, organizing and controlling an organization financial resource to achieve its objective. This report present a comparative financial analysis of Supermax Corporation Berhad and CarePlus Group Berhad. The two companies is a publicly listed company operating in Malaysia wellness industry. These companies were selected because their core business strongly linked to wellness industry. The Supermax Corporation Berhad is one large glove manufacturer in Malaysia. The company also involved in healthcare distribution that serve hospital, clinic, laboratories and wellness center worldwide too. Financial ratio and forecasting are important for the business or company to help company measure its performance, identify the risks that will occur and plan for a sustainable long-term growth. They also provide insight from firm current financial health while forecasting project outcome that enable the company a better decision making.
Hi Doctor, my name is Muhammad Nafari Aziz Bisirat. My matric number H24A3101. Today I will present about background Supermax Corporation Berhad, one of Malaysia's largest and most successful medical glove manufacturer. Supermax Corporation Berhad, founded in 1987 by Datuk Seri Sentetai and Datin Seri Karitan, began as a trading business in latex glove before shifting to manufacturing in 1989 and development in own brand. Today, Supermax operates several modern facilities in Malaysia, producing latex, neutral rubber glove, exporting to more than 165 countries with the support of over 1,200 global distributors. In 2016, the company diversified by becoming the first Malaysian firm to manufacture contact lenses after ending in the United Kingdom, and its lenses are now distributed to more than 16 countries. Supermax has received numerous recognitions, including the Eagle Billion Ringgit Club Award 2010, Export Excellence Branding Award 2008 and 2009, and the Deloitte Top 50 Enterprise Award 2006, reflecting its commitment to quality, innovation and productivity. With a vision to be a trusted global producer of protective products, Supermax continue to emphasize technology advancement, increase production capital and compete with international standards, establishing a competitive influence and internationally recognized Malaysian company.
Assalamualaikum warahmatullahi taala wabarakatuh. My name is Zuhmi Zahin. My matric number is H24A 3775. I want to talk about background company. Plus Group Berhad. Plus Group Berhad is a Malaysia-based glove manufacturer specializing in medical and industrial glove. The company was incorporated in 2010 and later listed on Bursa Malaysia in 2021. Plus was successful transferred from a SCE market into a main market, reflecting its growth and credibility. Plus operate globally and export its product to over 120 countries, including Europe, North America and Australia. In conclusion, this two company has so many benefits to our country and our economy.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Eman Najmi bin Muhammad Izam. My matric number is H24A2911. I'm going to present about the trend analysis for Supermax Corporation Berhad and CarePlus Group Berhad. First, we move to the Supermax Corporation Berhad trend analysis. For the liquidity ratios, the current ratio increased from 5.54 in 2023 to 6.07 in 2024. This shows that the company can settle its short-term obligation because its current asset is more than the current liabilities. For the equity ratio, it increased slightly from 5.22 in 2023 to 5.49 in 2024. This shows that the company is not overly dependent on selling its inventory to pay debt. For the cash ratio, it shows a slightly decrease from the 4.31 in 2023 to 4.19 in 2024, but the company is still very strong because they have enough cash needed to cover their liabilities. Then, for the efficiency ratios, we start with asset turnover ratio. It shows a slight decrease from 0.16 in 2023 to 0.13 in 2024. This indicates that the company are generating less sales from the asset. For the inventory turnover ratio, it also slightly decreased from 0.26 in 2023 to 0.22 in 2024. This indicates that the company inventory is being sold frequently, possibly due to lower demand. For the account receivable turnover ratio, it decreased from 6.21 in 2023 to 4.25 in 2024. This shows the company collection from the debtor is lower. After that, the solvency ratio for debt to equity is same in the year 2023 and 2024, which is 0.2. This shows the company is not dependent on debt financing. For the debt to asset, it slightly decreased from 0.06 on 2023 to 0.02 in 2024. This shows the company have strong solvency and assets are mostly financed by equity. For the interest coverage ratio, its value increased from 25.26 in 2023 to 33.30 in 2024. This shows the company can easily cover interest payment. Next, for the Z-score, it also increased from 5.87 in 2023 to 7.69 in 2024. This shows the company financial stability is improved. Lastly, for the profitability ratios, the gross profit margin is slightly decreased from 80.41 in 2023 to 80.23 in 2024. This shows the company cost control is consistent even though sales volume is lower. For net profit margin, it increased from 20.88 in 2023 to 28.34 in 2024. This shows the company is more efficient in turning sales into net income. For return of equity, it also increased from 3.65 in 2023 to 4.10 in 2024. This shows that the stakeholders for the company are getting better return. For return of asset, it increased from 3.40 in 2023 to 3.59 in 2024. This shows the company assets are generating slightly better returns. Next, for the CarePlus Group Berhad, we start with the liquidity ratios. The current ratio value declined from 2.69 to 2.38. This shows the company current liabilities is higher than the current asset that make them cannot settle the short-term obligation. For the quick ratio, its value also decreased from 2.62 to 1.67. This shows the company have a weaker short-term liquidity without relying on inventory. For the cash ratio, it also decreased from 1.90 to 0.5. This shows that the company don't have enough cash to pay for debts, operation and investment. Then, for the efficiency ratio, for the value for asset turnover ratio is decreased from 0.85 to 0.23. This shows the company asset were under to realize. For the inventory turnover ratio, its value decreased from 2.29 to 0.58. This shows the company cost of goods sold is lower and higher inventory level that cause overstocking. For the account receivable ratio, the value decreased from 20.44 to 4.89. This shows the company took longer times to collect their money from their customer. After that, solvency ratios. Its debt to equity ratio value remains stable for both years. This shows the company debt and equity grew proportionally. For debt to asset ratios, its value slightly increased from 0.12 to 0.13. This shows the company reliance on debt financing. For interest coverage ratio, its value dropped from 67.69 to 11.2. This shows the company ability to cover interest expense is lower. Then, for the Z-score, its value increased from 3.90 to 4.25. This shows the company investor has strong confidence in company's future prospect. Lastly, for profitability, the gross profit margin value is negative from negative 34.09 but improved to negative 24.93. This shows the company cost of goods sold exceed revenue in both years. That means they sold at loss. For the net profit margin, its value decreased from 71.79 to 32.60. This shows the company managed to cut expense or had non-operating gains. For the return of equity, its value dropped from 82.17 to 9.90. This shows the company shareholder earn far lower return. For the return of asset part, its value also dropped from 62.92 to 6.83. This shows the company are not generating enough earning. That's all.
Assalamualaikum. My name is Muhammad Ali Fildan bin Ali Effendi. My number matric is H2483506. For this analysis, I will explain the financial performance of CarePlus Group Berhad compared with Supermax Corporation Berhad for the year 2023. First is liquidity. Supermax show higher current, quick and cash ratio compared to CarePlus. This means Supermax is more able to pay its short-term liabilities, while CarePlus still has acceptable liquidity but at a lower level. Net is efficiency. CarePlus has higher asset turnover, inventory turnover, and receivable turnover ratios. This shows that CarePlus is more efficient in using its assets, managing inventory, and collecting receivable compared to Supermax. In terms of solvency, Supermax company is more safe because it uses very low debt and depend more on equity. The risk is low and financial position is strong. CarePlus company use more debt, so the risk is higher, but still can be okay if debt is managed well. For the Z-score for Supermax is 5.87, which is above the safe zone. This shows that Supermax is financially stable and has low risk of bankruptcy. Lastly, profitability CarePlus show mixed results. The gross profit margin is negative, which means the company face high production costs. However, net profit margin, ROE and ROA are very high, showing strong profitability and good return to shareholders in this year. Overall, CarePlus is efficient and profitable, but need to improve cost control, while Supermax is stronger in liquidity. Now, for the year 2024, a cross analysis between Supermax Corporation Berhad and CarePlus Group Berhad. First, for the liquidity ratio, Supermax has higher current ratio and quick ratio than CarePlus. This means Supermax is more able to pay short-term debt. CarePlus liquidity is lower and cash ratio also very low, so cash position is weaker. Next is efficiency ratio. CarePlus has higher asset turnover and inventory turnover. This show CarePlus use their assets and inventory more efficiently. Supermax turnover ratio are low, so asset usage is not very good. For solvency, Supermax has very low debt to equity and debt to asset ratio. This means Supermax use less debt and has lower financial risk. CarePlus has higher debt, so risk is higher. For profitability, CarePlus has higher net profit margin, ROE and ROA, but gross profit margin is negative, which show cost problem. Supermax profit is more stable but lower. Lastly, Z-score Supermax is higher than CarePlus, so Supermax is more financially safe. In conclusion, Supermax is stronger in liquidity and solvency, while CarePlus is better in efficiency and profitability.
This is the graph for trend analysis of company Supermax Corporation Berhad. For the next page, the graph of trend analysis will be for CarePlus Group Berhad.
This is graph for cross analysis between Supermax and CarePlus for the year 2023, and for the next page is for 2024.
Assalamualaikum, my name is Muhammad Dini Nazir. My metric ID H24A3606. Moving on to interpretation result of trend analysis. Between 2023 and 2024, Supermax Corporation Berhad demonstrated strong financial health. Its liquidity improved with both the current and quick ratios increasing, while the cash ratio declined only slightly. This shows that Supermax had more than enough liquid assets to cover short-term obligations. However, its efficiency weakened as asset turnover, inventory turnover and receivable turnover all fell, indicating slow operation and longer payment collection period. Despite this, the company's solvency remained very stable, with extremely low debt levels, rising interest coverage and a stronger Z-score, reflecting long-term financial security. Profitability also stayed steady, with a stable gross margin, higher net margin and modest improvement in returns. Overall, Supermax remained resilient with only minor concerns about efficiency. In contrast, CarePlus Group had faced significant financial challenges. Its liquidity ratios declined sharply, especially the cash ratio, which show reduced ability to meet liabilities without relying on inventory. Efficiency also dropped severely, with asset, inventory and receivable turnover falling dramatically, signaling operational strain. Solvency results were mixed, debt levels stayed stable, but interest coverage fell drastically, suggesting weaker earning capacity. Profitability was highly volatile, with gross margin all negative and net margins, return on equity and return on assets all declining sharply. This indicates the CarePlus struggle to generate sustainable profits. In conclusion, Supermax show consistent strength and stability, while CarePlus experienced major declines in liquidity, efficiency and profitability overall. Supermax is in a much stronger financial position compared to CarePlus during the 2023 to 2024 period. Interpretation of result for year 2023 for Supermax versus CarePlus. In 2023, Supermax Corporation Berhad shows stronger liquidity than CarePlus, with higher current, quick and cash ratios, giving it more flexibility and lower risk. CarePlus maintained acceptable liquidity but weaker overall. In efficiency, CarePlus outperformed Supermax with faster asset turnover, inventory turnover and receivable collection. However, in solvency, Supermax was clearly superior with very low debt and strong interest coverage, while CarePlus carry higher leverage. For profitability, Supermax recorded steady and realistic margins, while CarePlus showed unusually high returns but a negative cross margin, suggesting one-off gains rather than sustainable earning. Interpretation of result for year 2024 for Supermax versus CarePlus. In 2024, Supermax continued to lead in liquidity, maintaining strong ratios, while CarePlus saw sharp declines, especially in cash reserve, which reached critical levels, efficiency weakened for both, but Supermax decline was modest, whereas CarePlus drop was severe, reflecting weak revenue generation and inventory management. Solvencies again favors Supermax with low debt and rising interest coverage, while CarePlus earning capacity fell. Profitability remained stable for Supermax with improvement in net margins and returns, but CarePlus struggled to convert revenue into profit, facing ongoing operational challenges. In conclusion, Supermax consistently demonstrated stronger financial health across both years with high liquidity, solid solvency, and reliable profitability. CarePlus, on the other hand, faced declining liquidity, severe efficiency issues, and unstable profitability, making it more vulnerable. Overall, Supermax was clearly better positioned to sustain growth and meet obligation compared to CarePlus during 2023 and 2024. That's all from me. Thank you.
My name is Muhammad Ahmad Ikmal bin Hassan Yahya. My metric number H24A3607. Today, I will talk about financial performance of Supermax Corporation Berhad and CarePlus Group Berhad for 2023 and 2024. Focus on liquidity, efficiency, solvency, and profitability. In terms of liquidity, Supermax show a very strong position. Its current, quick, and cash ratio remain high, indicating a strong ability to meet short-term obligation. In contrast, CarePlus experienced a significant decline in all liquidity ratios, suggesting weaker short-term financial strength and highlight higher reliance on inventory. Further efficiency perspective, both companies record decline. Supermax experienced lower asset utilization and longer receivable collection, but its performance remained relatively stable. However, CarePlus suffered a much more severe drop in asset, inventory, and receivable turnover, reflecting serious operational inefficiencies and weakened sales performance. Regarding solvency, Supermax maintained a much stronger position with very low debt, high interest coverage, and improving debt score, indicating strong long-term financial stability. CarePlus, although still solvent, show weaker performance due to its sharp decline in interest coverage. Supermax demonstrated stable and improving performance with rising net margin and modest growth in return. On the other hand, CarePlus showed extreme volatility with negative gross margin and sharply declining return, indicating unstable profitability. Overall, Supermax clearly outperformed CarePlus across liquidity, solvency, and profitability, making it the most more financially resilient company. CarePlus faces significant financial pressure and must take urgent steps to improve liquidity, efficiency, and profitability.
Hi, my name is Muhammad Alif Hakimi bin Sukari. Number metric H24A3420 from Group 11. I will now present the conclusion of our financial analysis comparing Supermax Corporation Berhad and CarePlus Group Berhad for 2023 and 2024. Our analysis clearly shows that Supermax is financially stronger and more stable. It maintained high liquidity, low debt, strong solvency, and consistent profitability throughout both years. In contrast, CarePlus faced challenges including declining liquidity, falling efficiency, negative gross margins, and unstable profit, while CarePlus remains solvent. Its financial performance signals growing operational risk. Therefore, Supermax is better positioned for sustainable growth, whereas CarePlus needs urgent improvements in liquidity, cost control, and operational efficiency to restore its competitiveness. Thank you.
This is the reference and appendix part. For the reference, this is the list of reference that we use to make our group assignment. For the appendix, it contains the statement of financial position and statement of profit or loss that taken from the annual report from the both company. That's all.